Good morning, everyone. Welcome to the Macro Snapshot. We, of course, are September the 11th, 2025. Let's just see what's going on. Recording this in the morning, as always. What we have today, guys, we have the important in the US, we have the CPI. Let's just review and see what happened yesterday. Of course, we had a pretty soft PPI yesterday. Unusually, that came before. So let's just review those numbers quickly. We can see that the PPI numbers here, especially the month-over-month numbers, you can see here that the priors for some of them here, like final demand month-over-month, is 0.9, expected at +0.3, came in at minus 0.1, minus 0.1. And then also there's some revisions. You see that there are also revisions. So point is that you could talk about the details, but overall, that was not only a soft number, but a much softer number than expected. And so normally when the PPI, when the core number and the headline number go in the same direction, historically, that's a good indicator of CPI. So one could possibly assume today, just putting it back onto the CPI, putting it on today, that this number will be, relatively soft, and at least we could say it shouldn't be too high. So what we're looking at here is the CPI month over month. So the headline is 0.3, up over 0.2. But yeah, having said that, looking at yesterday's PPI, there's a chance that could actually maybe come in at 0.2, even 0.1, so a bit softer there. Excluding food and energy, so the core number, again, expected to come in at 0.3. So that's really the consensus there. Year over year, expected to go 2.7 up to 2.9 for the headline, and that up into the 3 handle. So the Fed would quite like here to see this coming in a little bit. And for sure, at this point, if we actually look at what the Fed's, the market is pricing for the Fed, it is one cut, as we know. We look at this every day. But you can see here for September that we're pricing in 27 basis points. So, technically, mathematically, a little bit more than 25 basis points. So over one cut. And then if we look out for the rest of the year, we're up to 2.7. So almost a second cut priced in for October. And then by the time we get to Christmas or December meeting, we have 2.7 cuts. So 68 basis points in total. So the thing today is, how could the market react? The market is expecting a number. Well, first of all, I think would be an asymmetric shock if it's higher than expected after PPI yesterday. Although, will the cut would a higher number prevent the Fed from cutting? I don't think so. So that could be a relatively short-lived move. And maybe even is a move to fade. But let's say something like 0.4, for sure, this could bring this pricing down to, let's say, 25 basis points rather than 27. Something like that is absolutely possible. Now, in terms of a soft number, so if we get a 0.1, a 0.2, obviously the Fed would welcome that, the market would welcome that. And we get probably then, there's a chance that this 2.7 cuts goes to 3 cuts. So I think definitely 68 basis points in some shape or form that could go, head up towards 75 basis points. So we still have about 7 basis points there in terms of the SOFR curve, which could be priced. Now, the question is that priced evenly over September, October, and December? Or would the market at that point start to sniff out the possibility of a jumbo cut, so 50 basis points for September? It's possible, but mathematically, either way, a soft number would definitely get the front end of the curve. And possibly a nice way to play that would be, let's say, December SOFRs, which would get all of the 3 moves that would encompass that in a cumulative kind of sense. I'm just going to grab some tea here. If we also look at the market reactions, it's going to be quite important here also because we also have initial jobless claims. And keep in mind that, one of the narratives the market is trying to figure out at the moment is lower inflation purely good news? We go, oh, great, the Fed will cut. Inflation is coming back down to target. Life is wonderful and the stock market can keep on rallying. It's possible. But the other part of that equation is also, we saw yesterday that profit margins in companies in the PPI, they seem to be cutting back on their profit margins. So it's possible that we're not getting the full flow-through effect of the tariff inflationary effect because companies are basically saying we cannot raise prices because we don't think that the consumer is strong enough or resilient enough to accept more price rises. So therefore, the profit margins are possibly going down. So it could be that this sort of lower inflation is simply a reflection, I'm talking of the PPI and possibly the CPI today, it's possibly a short-term reflection that companies just don't feel comfortable or able to increase prices. And again, that's going to be, that's going to impact their profit margin. And eventually you'd have to say, could that spill over into the stock market where we start to see earnings earnings coming down or earnings estimates coming down? So really what we're trying to figure out here is, is this inflation just benign? Oh, inflation is lessening. Or is it a case that the consumer is tapping out and maybe demand is actually falling off a little bit? The consumer is not feeling as confident. Demand is falling off. Companies not able to raise their prices and sort of pass on in input costs. And that's a different scenario. That's an economy which is slowing, and hypothetically that could be quite bad for the stock market. So we'll get a little bit of the reason I'm saying all of this is that A, it's interesting in and of itself, but B, we're going to get to the initial jobless claims today. And remember last time we got 237,000 jobs. It is starting to tick up a little bit. We're no longer getting this sort of 210, 220. So it is going to be important for the market today to look at this number and try and get a sense of whether the job market is actually weakening. Now, remember, we had those huge revisions downwards, about 1 million jobs, which we got at the beginning of this week. We also had the non-farm payrolls, which was negative, not negative, but was trending in a negative direction. And therefore, it is important. Also, we want to be looking at the 4-week moving average, which is about 231,000, and the continuing claims, because one of the market's sort of narratives at the moment seems to be that people there's not huge amounts of layoffs and firings, but companies are not exactly sort of happy to re-employ other people. So it's almost like this static kind of situation. And with less undocumented immigration, there's less workers available, and that's keeping the job market kind of stable. But actually, companies are really not employing new people, and therefore the continuing claims. So people who are in multiple weeks trying to find another job, that's getting harder and harder. So that was at 1.94 million, expected to tick up to 1.95 million. So let's keep an eye on all of that stuff together with the CPI. And of course, that's going to feed in through to the markets. Anything soft is going to be probably good for gold, bad for the dollar, good for the front end of the curve, probably would cause potentially some kind of steepening. Although we have seen some flattening, just on the idea of, is this simply about the Fed cutting interest rates, or is this about demand and the real economy falling off? And possibly the initial jobless claims, we have to read that in conjunction with the CPI to make that distinction. Is it just an inflation story, or is it a lack of demand or a softening of demand, softening in the labor market story? In which case we may not get a steepening because the front end, those yields will go down, but possibly back end yields also will go down as well. Maybe not as much, but will go down just on the idea that the economy and future growth is flattening out a little bit. Interesting stuff. Okay. We'll see all that at 8:30. Now, the other thing we're getting, of course, at this morning is the ECB. Now I've got here, let's just have a look and see what the ECB is up to here. So we can see that their deposit rate is at 2%. Technically 1.92 is the effective rate, but let's call it 2% is the deposit rate. They are absolutely expected to do nothing in terms of the interest rates. As you can see here, the implied rate of change is nothing. The chances of a cut is nothing. But what's interesting, if we actually just look further out into the future, you can see that the market, if you go all the way out to 2026, so June, July 2026, is only pricing in 1/2 cut extra, so 14 basis points. And this is kind of, we can look at this if we look at the Euribor curve. So this is like the SOFRs, this is the short-term curves. You can see here that it looks like there's sort of like some kind of cutting cycle. But if you actually look at the numbers here, you can see here that the implied yields, you're going down, about 2% down to about 1.92%. So this is only 8 basis points, 8 basis point. 0.08 of 1%. So this looks like it's some sort of cutting cycle, but actually compared to the Fed, not at all. And I just wonder if that's a little bit on the hawkish side. Talking about that, it is kind of interesting here. What I've put up here is the SOFR curve, which is the white one, compared to the Euribor curve, which essentially we just looked at. And you can see here that it's a very different curve. That, first of all, we do have to acknowledge the fact that the ECB has cut a lot more aggressively over the last 12 months than the Fed. And so you can see here that where we're at with the in Europe is around about sort of 2% or so. But as we just saw, their cutting cycle is expected to be extremely minimal, basically. Whereas as the Fed, as we know, it's now priced for a trough, a lower, got to 2.87. So the Fed, the market is pricing for a relatively, I don't say aggressive, but a Fed cutting, 5 to 6 times, so about, 125, 150 basis points, all the way to the late twos, so, 2.8, 2.9%, which will still be above the European rate. But as you can see here, the direction of travel is very different. And what we know from markets, it's not levels, it's the direction of travel which counts. So this potentially has implications that, for sure, this is in some sense sort of already priced in by the market. But if you look at something like the euro, it does seem, at least according to where the market is at the moment, the pricings for the market, that the Fed is going to be the one which is going to be very dovish, whereas the ECB is expected to stand pat and do basically nothing at all. Now, what should we be looking out for today with Lagarde? As I say, no one is really expecting any kind of cut. That would be a major shock. Obviously, no hike. So we really want to see what Lagarde has to say about growth forecast, because at the moment there's been, the doves, the hawks especially, there's been there's quite a sanguine sort of viewpoint of the European sort of economy, that inflation is more or less defeated, that the energy prices have stabilized, unemployment rates reasonable and acceptable, and that everything is not too bad, even a little bit of slight growth. So it's interesting. It will be interesting to see what Lagarde has to say in terms of the outlook for growth. Will she signal that there are significant downside risks still? That would be dovish. Or does she give a relatively upbeat, positive, neutral kind of sort of forecast, so to speak. So that's what I'll be mainly looking at is what she has to say about growth. Keep in mind anything which signals sort of potential weaker growth or sort of risks to the downside for growth, that would be dovish. And we could see some repricing here in this future curve a little bit further down. As I say, only 50 basis points priced in of cuts in the next 6 or 8 months, which personally I think is possibly a little bit on the hawkish side. I do believe there's a possibility at least for one cut cumulatively to be priced in. Other thing which we want to listen out for from Lagarde is France, the situation in France. We know they have a new prime minister, Mr. Le Cornu, who, we'll see what he's able to do politically. But in terms of the bonds and the fiscal situation over there, it's going to be very interesting whether Lagarde mentions that at all. She may choose not to mention it, although I imagine the journalists will be questioning her about that, and whether she believes that there is some sort of instability there, anything the ECB may or may not do. Will she mention the transmission protection instrument, the so-called TPI? The idea of that is to flatten the spread. So if some member states yields start going up too much, like the Italians or the French in this case, or the Portuguese or the Spanish, they have this new instrument, the transmission protection instrument, which is essentially a kind of a QE. It's like when the central bank will buy those bonds to try and flatten those yields and keep all the spreads, especially in the periphery, contained. So it's going to be interesting whether she mentions that, how she responds to questions about that in France, and anything which she sort of indicates that that's an issue they're looking at. It could be, interpreted as a dovish kind of reaction. So let's just have a look and see just a couple of the charts here. Again, looking at equities. So we see here we'll just keep on the ECB. I've got the chart up here. So here's the 2-year yield here on the Schatz, so the front end of the German curve here. You can see that the yield actually has sort of chunked up a little bit from about 1.65 at the lows. It's now up towards almost like 2%. So over the last 3 or 4 months, it has kind of ground up a little bit. And I personally think that's, maybe at the toppermost part of the band, at the top of its range here. I think, obviously, any comments today from Lagarde, but just in general, I think, if this were to get up towards, 2%, that's actually not a bad risk reward for going long the Schatz over the next, sort of, 2, 3, 4, 5, 6 months, because there are all kinds of political risk. You have geopolitical risk with what the Russians, sort of violating Polish airspace. We have the potential of, so the Russian-Ukraine thing is still happening. There's the potential for the Middle East to get a little sort of nastier, if Israel continues to bomb, sort of places like Qatar. So the point is here that's, I think, really at the top of its range in terms of the yield, in terms of the 2-year. Now, if the ECB, if those differentials over the next, if just talking about the differentials, if they do, if we have a look here, let's see, where's my German to US? Just give me a moment here. Right. So if we actually look here, let's say like the just on the 10-year, you can see that those differentials have come in a lot. So the US 10-year yield coming down a lot compared to the German now at about 1 point, was it 1.3? Now let's call it 1.4%. So you can see here it's come down from about 2% to 1.4. So it's come in 60 basis points. And at a certain point, um, that has weakened the US dollar. But I'm just wondering whether, we're getting that's going to come in a little bit more. It does seem that's going to be possible, especially at the front end of the curve. I mean, it's already moved a lot, the differentials. This is the US 2-year versus the German 2-year. You can see how much that's moved. But if the Fed does cut relatively aggressively, and apparently the ECB will not be cutting too much more, maybe once more, maybe not. You've got to say that that differential could come in a little bit more to 1.38, down to 1.38. So that's another 20 basis points in of the differentials. Now, if that's the case, one would assume that that's potentially a positive for the euro versus the US dollar, and is a bit of a negative for the US dollar in general against the other central banks, especially if you've got something like the Bank of Japan potentially normalizing a bit more, maybe in December or January of next year. There could be more downside pain for the euro, for the dollar index as well. So here we are with the euro dollar. As I say, let's see what Lagarde has to say, and let's look at those spreads, because if those spreads do continue to contract a little bit, there's no reason here, I think, why the euro at some point cannot sort of test up to the top of this range, maybe 118, maybe even sort of break it at some point. So that's something definitely to be looking out for. Other things today, just want to keep an eye on oil, continuing to have a little bit of geopolitical sort of tension, as I said, Russia, Poland, Russia, Ukraine, Israel, Qatar, Gaza, all of this kind of stuff. But basically, yesterday we got sort of unsupportive numbers from the Department of Energy. The inventories rose more than expected and more than the API number, which we had on Tuesday afternoon. So oil at this point, it's kind of stuck between two things. There's a little bit of geopolitical risk for sure, but the reality is that demand is relatively flat. Inventories, are forecast to sort of rise gradually as we go into 2026. And inventories, as we saw in the US yesterday, rising a little bit. And of course, we have OPEC plus, starting to increase their output. And let's not forget that there's countries coming online, a bit of oil. I was reading yesterday, you got Brazil starting to produce more and more. You even have Argentina starting to produce more and more, Canada. And then, of course, another source of oil is Guyana, those massive new oil fields which are starting to come online, basically now and, going into 2026. So that's almost, another million barrels a day coming from some of these sources. So the point is that there's plenty of oil in the world. And I think oil at this point, in the absence of any geopolitical risk, it could just drift, towards the bottom of this range down to $61 and even break it a little bit. I think at the moment it is, no pun intended, being kept afloat by some of this geopolitical risk. And if those factors were to fade, I think oil is going to find it hard to push through all this resistance. All of these are moving averages here, the 20s, 50, and 100. So any sort of Fibonacci retracement, we could just throw on a few fibs here. Any kind of Fibonacci retracements, which coincide with maybe some levels, something like up here, which is like the 50% fib, 65.85 on the WTI, are pretty good levels to, for a potential short. That's about it, guys. I think I'll leave it there. As I say, let's keep an eye on the euro, on the German bonds, just with Lagarde. And of course, at 8:30, we have all of the US data. So there could be a little bit of volatility happening in 30 to 45 minutes. Thanks very much. Have a great day. We'll keep this going tomorrow. Thank you.